Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, so let's get to our next guest, and let's talk a little bit about the economy, the soft landing, housing, jobs, and to Mark Zandi, Moody's Analytics chief economist, who joins us right here in New York City. Mark, good to have you here with Matt and myself. We were just talking with our Christopher Kane on earnings, saying very healthy, very robust. He talked about 80% of S&P 500 companies above their 200-day moving average. Does that square with what you are seeing in terms of the economy?
Yeah, well, that's very good. Good to hear. I'm glad to hear that businesses are doing well. Earnings are strong. Yeah, I think that's consistent with continued strong growth. Economists look at GDP. That's the value of all the things that we produce. That's up 3% year over year through the second quarter of 2024. Things are slowing. Obviously, the job market is throttling back, but so far that's mostly by design. The Federal Reserve has been working hard to cool things off to get inflation back in the bottle, and I think they've succeeded. Hopefully they start lowering interest rates here and keep the economy moving forward. But yeah, I think broadly so. I will say, businesses have, certainly large businesses have been doing very, very well. Corporate profitability economy-wide is about as good as it's ever been. I mean, margins are really extraordinary, and that's obviously, in part what's driving the equity market up to this point in time.
Mark, first of all, great to see you. I really appreciate you coming on the program. It's been a while since I talked to you. What about the consumer? We had reports yesterday from TripAdvisor not making as many bookings as people expected. The same was true with Airbnb. Disney came out this morning and said there's not as much growth at their parks, although people are staying home and ordering Disney Plus more often. Is the consumer in trouble here? Too much credit card debt from Taylor Swift last season? I mean, what's going on?
And it's good to hear your voice, Matt. Yeah, it's good to be on with you. Well, if you take consumers as a whole, the consumer elephant is a big thing, and a lot depends on which part of the elephant you're touching. But if you look at the elephant as a whole, it's good. Real consumer spending growth. That's after inflation, consumer spending all in, travel, the things that you've been talking about, what people are spending on streaming, all the things that they're buying for their homes, groceries, everything, up 2.5% year over year. I mean, that's been rock solid, amazingly so, for the last almost 2.5 to 3 years. And that's kind of right down the strike zone, right? That's exactly what you want to see. That's strong enough growth to keep the economy moving forward, but not too strong to fan those inflationary pressures. Now, if you touch different parts of the elephant, you start getting, a different sense of things. I mean, I do think lower income households are struggling, under the high interest rates and the credit card debt and consumer finance loans they took on back a couple, 3 years ago when, inflation was raging and they borrowed against their cards to supplement their income to maintain their purchasing power. And now the interest rates are very high. I mean, I just saw this the other day. I didn't realize that credit card interest rates at 22% are the highest they've ever been in the data that we have from the Federal Reserve. So, that is a lot of pressure. And those households blew through their excess saving early on, after the pandemic. So that part of the consumer elephant is soft and weak, and you can kind of hear it and feel it in some of the earnings announcements and what CEOs of consumer product companies are saying. But high-income households, middle-income households, no problem. They're fine. Just one last thing to say. The folks in the bottom third of the income distribution typically account for about 15% of the spending. The folks in the top third of the distribution account for 55% of the spending. So, I don't think the economy can flourish, and there's all kinds of political and social implications if folks in the bottom part of the distribution are struggling, but the economy can move forward, and it is. Now I don't want to, I just say one last thing and I'll stop. Everything I said is positive, but things are weakening. The high interest rates are doing damage. I think it's time for the Federal Reserve to start lowering interest rates and lowering them quickly and normalizing rates. And they've been late to the game. They've made a misjudgment here, so they have to get moving. But at least so far, the consumer, the economy is hanging tough.
Right.
Credit card interest rates are the highest they've ever been. Mark just points out the New York Fed put out today, total credit card debt ticked up to $1.14 trillion, and that is a new record high as well.
Well, and we had a story, I think it was yesterday, that talked about more folks looking to tap their home equity. I mean, maybe just because they can at this point, but they are looking to do it, and they're not moving around. We know that already. Having said that, Mark, so recession off the table in your view? I mean, obviously there might be some in the lower income strata that already feel like they're in a recession because they're paying more and they've got either higher credit card debt and it's much more troublesome. But having said that, a technical recession, do we avoid that, or at some point we have to touch it? You've seen lots of market cycles.
Yeah, I've seen many market cycles.
We all have.
Well, look, as long as the Fed continues to hold to a 5.5% close to funds rate target, we can't exhale. The economy is under pressure. Something can break, and when it breaks, it's going to break quickly, and it's going to be very difficult to fix it. I've heard the word "we can fix it." Okay, well, if it breaks, it's going to be very hard to fix it. So they need to move. Now, everything indicates that they're going to. And in fact, if there's a silver lining in this market mess that we've seen over the last week, is it's going to light a fire under policymakers, and I think they're going to cut. And I wouldn't be surprised if they cut a half a point at the September meeting and then be a bit more aggressive in lowering rates after that. If they do that, we're golden. We should be fine. If they don't do that, then we got a problem. And I would say at this point in time, just to put a number to it to give context, I say there's a 1 in 3 probability the economy enters into recession at some point in the next year. That's too high. That's uncomfortably high. In a typical economy, it should be about half that. So it's elevated, and it's going to stay elevated, and it's going to continue to rise until the Fed actually, starts to cut interest rates.
What do you think the terminal rate should look like? I was a little bit surprised yesterday when I typed in FDTR index on my terminal and looked at the federal funds target rate. I had forgotten that they raised rates so quickly in 2022. There were, not only they started with 25, went to 50, and then 3 or 4 consecutive 75 basis point increases, and another 50. So you expect a 50 basis point cut in September, and then what after that? Like, where are they going?
Yeah, well, I think a lot of reasonable debate about what the so-called equilibrium rate is, that rate, R star, that rate at which policy is neither supporting or restraining growth. But I think we can state with confidence it's not 5.5%. I'd probably, it's high. It's migrated higher for lots of different reasons, one of which is that the economy is more rate insensitive than it has been in times past because households and businesses have done a pretty good job of locking in the previously record low interest rates. So it hasn't flowed through in terms of higher interest expense in aggregate. I mean, again, putting aside lower income households and some businesses on the end of the distribution. So I'd say 4%. So if I were them, I'd be trying to get the funds rate target down from just south of 5.5%, where it is today, to 4% very quickly, by the early next year. And then take a look around. Hey, at that point, if everything's kind of sticking to script, hanging together, take a look around, see what's going on. You see how the economy's digesting all that, see what's happening with inflation. And then at the end of the day, my sense is the equilibrium rate out in the middle part of the decade, 2026, 27, is probably around 3%. It's going to migrate lower as liabilities, the interest rate on household and corporate liabilities adjust higher. And that's happening, over time. So that's kind of the path I think they should take. It feels more likely that that's the path they will take given recent events, but we'll see.
What's the role of Jay Powell at Jackson Hole come later August?
Well, if I were him, I'd send a very clear message. We're cutting rates. It's just a debate now to how much. And after September, how much we need to cut over the course of the next few meetings, just to lay any concerns, like folks like me who are saying, you got to get moving here. And if you don't, something's going to go off the rails. So I think that's got to be he's got to make this very, very clear. And I hopefully the board can sing from the same hymn book, kind of say, no, there's lots of different views, and that, it's okay, that comes through. But generally, when you listen to the melody, it's got to sound like everyone's singing the same melody, and that they're going to be cutting interest rates here. And if they do that, then I think we'll be just fine. The economy should be able to navigate forward and avoid a recession. If they don't do that, if he sends an ambivalent signal, maybe we will, maybe we won't, and there's a lot of discordant kind of views coming from different board members, then I think what we're seeing in the markets are, the extreme volatility and the red on the screen is going to continue.
Well, Mark, we're really squeezed for time. 20 seconds. What's the one thing you think the Bloomberg audience and investors should keep a watch on? Really a key metric for you, just quickly.
Initial claims for unemployment insurance. It comes out every Thursday morning. It had been around 200K. Right now, it's just south of 250K. Anything over 250K, yellow flares go off. Anything over 275 going to 300, then we got a problem. Recession looks more likely than not. So I'd watch that carefully.
We will indeed. Hey, listen, thank you so much. We both appreciate it, Matt and I. Mark Zandi, Moody's Analytics Chief Economist, joining us.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
You know how we said Supermicro was the worst performer, and I think both the S&P 500 and the NASDAQ 100? Number one decliner, well, the second worst performer in the S&P and the NASDAQ 100 is Airbnb.
Hang on, I'm writing this down.
Are you?
I'm going to use these with Romain later.
Yeah, right, exactly. He's got to do his decliners.
Yeah.
All right, so let's get to it, because Airbnb shares, man, they are definitely selling off the most ever. They reported their third consecutive quarter in which it offered a downbeat forecast to investors, also warned of slowing demand from U.S. vacationers. So let's get into what you really need to know and what's the outlook. Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh, he's back with us here in our Bloomberg Interactive Broker studio. Doesn't feel good at all, but how do you see? Investors certainly don't like it.
Well, the guidance was weak, and in Airbnb, the risk for the longest time has been saturation. Even though this could be tied to macro and consumers slowing down, they talked about the booking window shortening because people are booking travel at the last minute. But when you think about Airbnb as a vacation rentals company, they operate in a market which is supposed to be much smaller than your overall lodging travel market, and that's the part that investors are not clear on. How much runway do they have in terms of taking share from traditional hotels? Because they clearly had some sort of a pull forward during the pandemic and in the couple of years after that, and now they're running into tougher comps. They're not acquiring as much supply as they were in the last 2 years. So it's really about what is it beyond alternative accommodations can they do? And they're still a single product company. So that's
So when you say saturation, do you mean basically everybody who was going to rent out her house on Airbnb already has rented out her house on Airbnb? Everybody who did decide to rent a few apartments and do an Airbnb business has already done that, and there's just not a lot of growth left.
Yeah, and also from a user perspective. So think of, how you segment the demographics who use Airbnb. Not everyone uses Airbnb, and I think what they're realizing is not everyone will use Airbnb just because there are certain people who will still prefer hotels. So the use cases for alternative accommodations are those high-end rooms for, larger groups. And that's where it gets used more and more. And
what you mean, like if I'm going to the Masters with 4 of my buddies, we rent some big McMansion right outside Augusta.
So that's the typical Airbnb use case. But beyond that, I think the corporate use case isn't there. And so they need to layer on new products. They have launched experiences, they have launched rooms, but nothing has really worked for them in terms of those incremental revenues.
So do they have to become more traditional, like a hotel company?
I mean, they did acquire a company, Hotels Tonight, but when people think about Airbnb, their branding is it's vacation rentals, alternative accommodations. And sometimes, it's good to have a brand because it saves you sales and marketing expenses, but also people associate certain type of, image. And that's...
How much of this is a problem with the consumer, Mandeep? Because we got a string of bad consumer earnings. Okay, we were reminded a little bit earlier that overall earnings season has been good. Overall, companies of the 470 who've reported so far out of 500, earnings are up 11%, 12% year over year.
80% beating expectations.
Yeah, well, they always beat expectations.
Okay, you're right.
But I'm talking about growth quarter over the same quarter last year.
Wasn't it 13%?
13% the expected final count, but right now on EA Go, I can see 11% so far. Anyway, it's good. Right? But what we got yesterday with TripAdvisor, which is in a similar business, bookings are down. We got Airbnb, bookings are down. Disney came out this morning and said, you know what? Not as many people are coming to our parks. They're getting Disney Plus and Hulu, but they're not necessarily taking the big plunge and going to Disney World. So is it the consumer that's really shaky here?
It is. And look, the trends are decelerating in terms of top line growth, in terms of estimate revisions. So in the case of Airbnb, you will see negative revisions for EPS growth in 2025.
Yeah.
And that's where it's hard to sustain that kind of multiple. So if you're trading at the premium multiple, which Airbnb is, it's hard to sustain that multiple if your estimates are going revised downward. And I think there's nothing wrong with Airbnb. It's got a great moat. It's a great business.
Yeah.
It's just that saturation aspect and the premium multiple is what's driving the stock.
So
down.
reset may be needed on expectations among investors. Having said that, Airbnb CEO Brian Chesky responded to the company's disappointing outlook and the plunge in the share price on X. He said, "I'm confident it's a good time to buy."
He is?
That's what
Wait, so he likes his own company?
Shocking.
Amazing.
He should be announcing a big buyback. How about that?
Well, I mean, how much money do they have to play around? What's their cash flow look like?
It's a great business model, 30% free cash flow margin. So really, out of all the marketplaces, Airbnb is one of the better marketplace business models. It's a two-sided marketplace as opposed to three-sided. Three-sided, your margins are much lower.
And now you're confusing me, dude.
So
Wait, two-sided. So wait, Uber, is that three-sided?
Uber is ride sharing is two-sided.
Two-sided.
The delivery is three-sided because there you have the restaurant, the delivery guy, and Uber. Whereas in the case of Airbnb, it's just the host and the guest, and they are the intermediaries. So
Thank you for explaining that.
Wait, I've never heard it that way. You mean
Yeah.
you're talking about kind of like the touch points, basically?
Yeah, exactly.
Ah,
This is why we have BI analysts on.
I know. Well, this is why we have Mandeep.
Do you know what's
to,
a really
like,
cool
explain
function?
Everything. In
If
our
you're
world.
looking, if you want to know who covers Uber, you can type Uber equity and write BICI go.
And you know.
And you find the primer and you see the analyst and
I
it's
do it
cool.
differently. I just like pull up the ticker and then I pull up BI stories.
All right, that works too.
I guess so. All right. Anyway, very cool. What should we have on our radar when it comes to Airbnb? Like kind of keep going into, I guess, the next quarter or this current quarter?
I mean, look, all the marketplace companies have reported now. Uber had a good print, DoorDash had a good print, but the other ones didn't. And so it's more about, what sort of guidance we get from consumer-focused company. And don't underestimate Gen AI's application to marketplaces.
Oh, interesting.
Brian Chesky did mention a lot of the UI for these marketplaces, even for booking travel, will change as a result of generative AI. Now, if he shows something like that, I think that will be very exciting for investors to see that Airbnb is at the cutting edge of driving that change when it comes to leveraging generative AI.
All right. Pretty cool. Pretty cool stuff. Thank you, Mandeep. As always, Mandeep Singh, Senior Tech Industry Analyst at Bloomberg Intelligence, joining us in studio. I'm just taking a quick check at Airbnb, which will be one of your decliners, I'm assuming.
Yes.
Down 14%.
So wait, what am I going to do? I'm going to do super micro.
Super micro and
I'm gonna
Airbnb.
do Airbnb.
And we'll pick out another one for you.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Carol Massar along with Matt Miller, who is in for Tim Stenovec right here on Bloomberg Businessweek. I feel like we're sharing our war stories of being like, let go or almost let go.
Going through layoffs.
It's
layoffs.
Tough
when people
it's
have,
horrible.
Pink slip parties puts too much of a positive spin on it. But
It's
that's when I
fun.
first encountered real layoffs because I started this job during the .com bubble burst.
And that's
I remember friends of mine were all sort of commiserating with each other over getting fired from their first jobs. And fortunately, I was at Bloomberg.
Okay. Anyway, so that gets us to a story that is among the most read on the Bloomberg. It's a Business Week story by our WorkShift team. It's about the true cost of layoffs. It is, as I said, among our most read today. Let's get into it with Matthew Boyle. Matt, by the way, is Bloomberg News Senior Management Workplace Reporter. He joins us here in studio. All right. I am curious, though, why you guys are doing this story now. Is it because of some of the softness that we continue to see in the labor market?
No, Carol, I started work on this story 6 months ago.
Oh, you did?
Yeah, when layoffs were layoffs, when have they not been, coming hot and heavy, and just with Intel recently and Dell as well. But you see all these press releases, you read the memos from the CEOs, streamlining, efficiency, blah, blah, blah. And then the SEC filing goes out and they say, we're taking a charge of X million for severance. I'm like, okay, there's got to be more to it than that, right? What's the true cost of a layoff? Because I've been laid off And we've, either
I've
you've
been
been
laid
laid off or you've done a layoff. I think all of our listeners fall into one of those two categories. And you see what happens to the survivors, the people who are still there. They're like zombies at times. They're worried about another layoff coming. They now have to do the work of 2 or 3 people. So, your engagement goes down, your morale goes down. You're kind of looking out the door like, maybe I should be down the street taking a job somewhere else.
Yeah, a lot of other people
Exactly.
just leave because
So
they're like,
we
listen,
know-
we're doing
Yeah.
layoffs.
Exactly.
I need to get out of this business.
So we know that output declines. We know that quitting goes up. But how much does this actually cost? We just kind of see these as like intangibles. Like, well, it happens, but, we had to do this. So I'm like, somebody must put some numbers behind this. So I dug around and finally found, I found an actuary at the Department of Labor. I found academics who have studied this. I found a guy who studied 200 layoffs and figured out how much did the quitting rate increase after
Oh my God, yeah.
the
But
layoff.
Matt, let's step
Yeah.
back and first look at just the direct costs.
Sure.
Because you're talking about the whole ball of wax,
Yeah.
right? But
Yeah.
you lead your story with the Facebook firings, and I knew a couple of young people that Facebook brought over here from Europe to work, and then almost all of a sudden laid them off and sent them right back. They had great packages,
Yeah.
and the whole thing was almost $1 billion, right? To
Yeah.
lay off 11,000 employees. That's like $88,000 a person.
Exactly.
And that's just the severance, right?
Yeah. So I looked in their filing and they said, well, after we 975 million or whatever it was in severance.
It's real money.
But it's not material because we're saving all this money. We don't have to give any of these people bonuses next year and we're saving this or that. And I'm like, there's got to be, again, more to it than that. So, but all we really know is how much they take in the charge for severance, which will cover, 2 weeks salary, healthcare continuation, outplacement, help with your resume. But again, the cost of a layoff goes so
what
much
are the
further.
biggest indirect costs?
Yeah,
like you got to
exactly.
bring in, I guess, Bain or McKinsey to make you feel better about it first, right? So you got to pay
Another
consultants.
cost. Yeah, there you go. No, Matt Boyle will do it for you. So the biggest ones are reduced productivity, output goes down. So I went to a firm called Active Track, and like other firms, so they're one of the biggest ones. They track employee activity. Now we've all heard about, they're watching your hours, they're surveilling you, and all these stories about employee surveillance. But employers do want to know, what you are doing on the company time. So this company was able to track pre and post layoff productivity at 7 anonymous firms. Obviously, I don't know who they are,
Right.
but we saw exactly what happened to productivity, and it was usually about an hour a day less productive. So that's 18 hours a month. Turns out to be, for every 10,000, for a company with 100 employees, that means more than $50,000 lost in productivity every month until it finally reverts to normal, usually after 6 months, but sometimes, not 6 months. So that's one of the big ones. Another one is increased quitting. People are worried about their own job, and so so you have an increase in what's called voluntary attrition, quitting.
Right.
Now, companies always have a level of attrition normally. It's usually about 19%. So usually you are replacing 19% of your people just because they found something better in general. But when you do a layoff, your voluntary attrition can go up by 50%.
That's a lot.
That is a lot, yes.
Well, and I feel like on the other side of that, like if you need those workers that are leaving,
Yeah,
that
those
you
are the
did
ones you
let
want to
go,
keep. Exactly.
that to bring them in, to recruit them, then to retrain them, that's
Yeah.
again another cost.
Yeah, so
down
those
the
are
road.
people you didn't want to lose in the first
Yeah.
place. They're not the people you laid off. Then you have to recruit and train their replacements. So all that has a massive cost, and I was able to determine it. So you take a normal turnover rate, you figure out how much it costs to replace the people you lose, the increased incremental quits, as I was calling it,
Right.
because it usually costs about 1.25x to replace a lost worker. So if you take, let's say, $65,000 average salary in the U.S., that's over $80,000 to replace them. Multiply that by the incremental quits. And at a 10,000 person company, you're talking about $75 million that you were not thinking you were going to spend to replace all these people.
I
for
have
this.
to say, you sound like an accountant. I'm kind of loving this.
Well, I'm a history major, so no, this was all new to me. But
It's wild, though,
I
the
had people
numbers.
walking me
Yeah.
through the math, saying, "Yeah, that sounds right," but I wish I could do it for like a particular company. get inside their books. That wasn't going to happen, so I just had to sort of guessestimate and do back of the envelope
I bet those calls
stuff.
went well. Hey, so and so.
Yeah, exactly. Hey, Meta, why don't you tell me what your
you have also, obviously we all pay unemployment insurance tax, so the company pays that, and because when Meta fires 11,000 people, a lot of them are going to go on unemployment and start collecting money from the state. We all pay for that collectively, but it turns out the state wants a little bit more from a company that fires people the next year, right?
Yeah, I filed that under boring but important. Of course, your unemployment insurance rate is going to go up because you just put some people on unemployment. So guess what? So there I've spent weeks finding this guy who used to be an actuary for the Department of Labor who was so tired of getting that question from people. How much is my UI rate going to go up? He built his own calculator to figure it out because it varies state by state, and all these laws and the formulation for it goes all the way back to 1935, and different states do it different ways. Long story short, this guy actually put a calculator together. So I said, hey, what if you're a Texas company and you lay off 10% of your workforce? He's like, oh, just plug it in. Boom. There you go. Your unemployment insurance is going to go up by such and such $1 million a year. That's another one. Then there's the lawyers. Let's not forget the lawyers. You got to hire lawyers to make sure you don't get laid off, and if you don't get sued,
right?
And you will get sued,
and you probably might get sued, but it might be a big, massive, ugly class action lawsuit, or it could just be one person who's like, "How dare you?" type of thing. But you have to analyze the demographics of the people you plan to lay off to make sure that no one group is disproportionately hurt.
It's not just a rash decision.
Unless it's just white guys.
Well, there are certain groups that,
I can't say that. I feel like that's fair, right?
And you do not want to get into a class action suit. So you have statisticians. So you got to hire statisticians. You can't just do this, on Google. You got to crunch the numbers, and you need a real number cruncher to do this.
You crunch the numbers for us, Matt.
We
Boyle.
did.
So appreciate
it. Hope you like the story.
We did. Bloomberg News Senior Management Workplace Reporter Matthew Boyle.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Having said that, we want to stay with this and bring into the conversation and welcome back retired Major General Mastin Robeson. He's a geopolitical intelligence advisor at Academy Securities Advisory Board, joining us here on Bloomberg Businessweek. General, you were listening to our Bobby Ghosh about the situation, and it does feel like, I agree with Matt, it does feel like constant escalation, even though Bobby said we're at a little bit of a holding pattern. How do you see it? How do you advise some of the clients of Academy Securities?
Well, I don't disagree with anything that was just said. I think there's some additional context, though, that is useful to add to it. Number one, in the last 2 decades, this is probably the most unified we've seen the Middle East with Israel and in opposition to Iran. That I think is curious. The April attack, 99% shot down, but a sizable contribution of that shoot down capability coming from Middle East countries that historically have not been necessarily, friends with Israel. I think what that says to me is Iran is dangerously close of further exacerbating their relationship with the Middle East and isolating itself more than it's even being isolated right now. I don't think it's any secret that most Middle East countries, not just Israel, consider to be Iran the number one aggressor and the number one threat to them and to democracy within the region. So I think you need to add that into the equation when you have this discussion. I also think it's interesting that there are many people whose calculus says that Iran's stockpile is not what maybe would it be to their advantage to do a large retaliatory strike at this point, particularly given the amount they used up back in April. So I think both of those play into the equation of how this plays out. We now have additional U.S. assets that have moved to the theater. I'm not suggesting they're going to be used, but I'm saying they do have an ability to have a de-escalation factor To my knowledge, Iran does not have an ability to defend against the F-22 that have now been moved into theater. I'm not suggesting the U.S. would use them, but I am suggesting that the calculus has been altered as Iran tries to consider what should their response be. They need to do something to save face, but I think they have to be very careful this time around that they do something that doesn't exacerbate their position either as a nation with their people or with the rest of the Middle East or with the world. And the final thing I would say is that there's still a significant amount of diplomatic and sanction efforts that could be taken against Iran. And given Russia, in essence, already coming on board, at least verbally stating their counsel to Iran about civilian casualties or avoiding civilian casualties, I think there's a lot of room diplomatically across the world to say we're going to further and more deeply sanction Iran and Russia as well. That also needs to, I think, factor into the calculus.
I was just thinking about that because we saw Israel assassinate the Hamas political leader in Iran last week, and I was surprised by the sheer number of people that came out to mourn, this terrorist group leader in Tehran. I didn't realize that so many everyday Iranian people support Hamas. How do you think the administration could change its posture in a more aggressive way to hold back this country that funds terror through Hezbollah and apparently through Hamas as well?
Yeah, great question. But before I go to your question, since you brought up the deep strike, it really has to be not just intriguing to the world, but the fact that Israel has the ability to do such a strike so deep into the Iranian state has to have Iran going, wait a minute, where did this come from? There's no way they weren't caught by surprise on inviting him to a diplomatic to a meeting with the leadership of Iran, and not realizing it by doing so, they were putting him in a position of danger. So I would add that to the calculus of what you just said. Now, in regard to the people's response, that's hard yes, there was a large response, but Iran is a 60 million population country,
right?
And there certainly are a sizable amount of people that the Ayatollah's network can influence and can stimulate. But I don't know that necessarily demonstrates that is the main Iranian response.
Forgive us, we do have to run, but glad we got some time with you to weigh in on this situation. Major General Mastin, Robeson, Geopolitical Intelligence Advisor at Academy Securities, joining us right here on Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, got about 18 minutes left in today's trading session. Charlie, of course, breaking down the numbers. We're pretty much hovering near our lows here on the equity side of things. Carol Massar, along with Matt Miller, in for Tim Stenovec. Hello.
Hi there.
Hi there. Let's get to our guest. With us is...
I'm excited about this.
Okay,
and you know why?
Take it away.
Because they're my bank.
I know. Is it really?
Chad Oviatt is here, Director of Investment Management, Huntington Private Bank. Full disclosure, that's where my family's been banking for generations.
Full disclosure.
And Chad, I got to ask you a question. After this insane week that, feels like it's lasted a month already, but you're sitting at home in Upper Arlington on a Sunday afternoon, enjoying some Rubino's pizza and some Grater's ice cream.
Oh my God!
Just back
I
from
love
the
when you
Columbus
go
Country
down
Club.
memory lane.
That's hometown right there.
You've had the disappointing, unemployment numbers, and you open up the paper and you see that Warren Buffett has sold off half his stake in Apple. How worried are you about Monday morning?
Well, and then you throw in something complex like a carry trade unwinding, and how do you even interpret that as an individual investor at home?
Yeah.
And so what we're talking to our clients about is really, this is why you diversify your portfolios. One, don't be reactionary. There's a lot of reactionary forces in the market this week, and this is a time to evaluate why you have things in your portfolio.
Yeah.
But as bad as the discussion was around equities on Monday, bonds were winning. And so when you have that diversification, you have optionality. And so if you do have positions in your portfolio that make you a little nervous right now, this is the time to be trimming or adding. And so trim those that maybe aren't part of the long-term portion of your portfolio, and think about adding to some names that maybe give you different return streams.
You're talking about the equity side of things? Or
Equity
all of it?
side.
Equity
Yeah.
side. All right, so give us some of that churn. So what would you sell? What would you buy?
Yeah, so look to be trimming some of the names that have been winning, right? Some of the technology names. We have, our equity team is really taking a barbell approach to risk right now in our portfolio construction. So technology absolutely deserves to be in the portfolio. Technology is not going to go backwards in terms of its advancements and what it can bring to us in the future. So that's our growth engine. But at the same time, you're looking at the volatility, you're looking at an economy that is, in our opinion, cooling, not cratering.
Yeah.
So now you start to think about what companies have historically rewarded their shareholders with dividends or buybacks, and who's in a position to take advantage of some of this market disruption. So we're looking at balancing some of the tech names with maybe some more of those dividend payers or things like.
So it's not a sector switch, it's a dividend or buyback play.
It's very much a security selection environment for us.
Okay.
And so we're looking for some of those high conviction ideas. And they can be, some of those household names, like an Ohio name, Sherwin-Williams, right? Has a history of a dividend that rewards investors for holding that security. Coca-Cola, if you want to go bigger global brand, same thing. They reward shareholders with dividends and buybacks, and they just have that brand recognition that should stay pretty constant. And those are not necessarily the antithesis of technology, but they're great complements.
Right. And I guess they can also, I can imagine how Sherwin-Williams and probably Coca-Cola too would employ AI to actually do something. I was talking to Nancy Tangler this morning from Tangler Laffer Investments, and she said she wants to look at old economy companies that can improve their productivity with AI, really digitizing their business. Or I don't know how I don't know how Coke would do it, but Sherwin-Williams I can imagine for sure.
Well, and they're tied into the DIY as well as the professional lines of business.
Right.
And then you think about the housing market. It's been tough, but at the same time, if you look at existing home sales being as flat as they are, there's no inventory. That means people are staying in their houses.
Listen, I'm thinking about repainting. Like Matt, you were talking, right? You're probably going to stay in your house for a long time.
Dining room color starts to look a little different, right?
There's a point where you start to rethink it. So when you think about, I want to go back to big tech for a second, though.
Sure.
When you think about maybe rebalancing or rethinking, how much do you pare back? How much do you still keep the exposure? Because
Good
we
question.
still live in a very technologically driven world, and while AI may have cooled a little bit, people are still talking about it.
And I think that depends on the individual investor and where they started. So for Huntington, our clients never really got to a full market weight in many of those names. We have risk controls in our portfolios that limit position sizes, and some of those names got to be beyond what our position limits would be for individual portfolios. So there's an inherent risk management in ours. So trimming and adding is different than somebody that went 10, 11, 12% into a particular name. So we're looking at opportunistically, maybe even adding to a couple of those that have been really beaten down lately.
I mean, if you're investing over the long term, right? If you're not a trader, and I imagine some people are trading with Huntington, but for the most part, you probably have people putting away money for the long term.
Yep.
You buy on dips. At least you dollar cost average in when you see that kind of correction, right? We were down basically 10% peak to trough on the S&P.
Yeah, that's exactly it. And for those, we've been telling our clients not to be overcashed, right? The one thing that we know for certain is that as interest rates start to go lower, whether that's because of market activity or Fed activity, cash yields are going lower. So if you have cash, be dollar cost averaging and look to those markets. Matt, you're absolutely right, where you can get in on some of those dips, be a long-term investor. And like we have a saying on our team, don't make short-term decisions with long-term investments, right?
Yeah, no, I get that. So if we get a recession? I'm trying to think about like being smart, because markets do have cycles. We do have recessions. Things go down. There are corrections, and then there's something more systemic maybe in the markets. Are you concerned, though, about there's geopolitics, there's an election here?
Tell us about the economy in Ohio. I mean, that's the heartland, right? I mean, that is, union country. How is it going with that consumer?
Yeah, actually, if you look at the states that Huntington is in, all but 2 of them actually have better employment statistics than the national average. And the 2 that don't, there's reasons why, and there's some great public-private partnerships that are helping to rectify some of those issues. But honestly, when we talk about the cooling versus cratering of the U.S. economy, if you were to really go all in on what happened on Monday, you basically are saying we think a recession is on the horizon and a bear market correction is also on the horizon. We don't think there's a case for either one right now. The employment numbers were a little weak, but we still added jobs. Manufacturing, weak, but service is good. And so there's this back and forth that and then you can look at the Atlanta Nowcast, 2.5 for Q3 on the GDP side. There are still some fundamental underpinnings that would suggest we're not heading to a recession, but this is where that optionality comes in. If you have a well-balanced portfolio and the market environment changes, the economic environment changes, you have some choices you can make.
I got a listener writing in with a question. Are you getting consistent questions from your clients when Jack Nicklaus calls you, when LeBron James calls you, when JD Vance calls you? Are you getting questions that we don't talk about here?
Yeah, and we just got about 20 seconds.
Oh, great.
Sorry.
A lot of it is timing. Do I stay in? Do I get out? Or what should I be doing with my cash? And we covered a little bit of that because we do have people that have savings. And right now the interest rate environment is still good for savers, but you're going to have to make some decisions soon.
All right, got to run. Chad, thank you so much. He is Director of Investment Management at Huntington Private Bank, joining us here in our Bloomberg Interactive Broker Studio. Folks, we've got about 10 minutes to go in today's trading session, and we are pretty much hovering near our lows of this session. This is Bloomberg Businessweek.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.